Welcome to All Things Financial, where we help you retire once and you can retire well. Join us today for our episode on investing for dummies. You're going to leave feeling like you've got a great foundation for getting started on investing. Welcome to All Things Financial, where we help you retire once so you can retire well. Today's episode is on investing for dummies. And one of the things I know is about 15 years ago, the episode that we've created today, I could have used. So thank you for joining us. Whether you're just getting started, whether you're in your mid-40s or you're about to retire, you're going to learn something today. Trey, Peterson, and
Yelisey, Kuts.
And I'm excited for today. And the reason I'm excited about it is because in 2015, July of 2015, I got into the business. So started doing commercial and business insurance right out of college and spent 3.5 years in that industry. Hated going to work most days, just wasn't my thing. Moved over into retirement planning because I had friends that they were in this space of helping people in and nearing retirement. And I'll never forget, I knew that I loved helping people. I knew that I loved the idea of helping people plan. I knew that I had a 401k and I threw money in it. But the truth was I didn't know very much about it. In fact, all I basically knew is that you could buy stocks in company and that you could buy the S&P 500. And I knew a little bit about that, but that was about it. And I'll never forget, about 4 months in, I was in a supporting role, what we call it a junior advisor or an associate advisor. And I knew I was with somebody that knew what they were doing. And so I was willing to buy into the fact that we could help people. So when I got started, you know, my role was really listening to what people needed, and then I would bring them to a team of experts. Yeah. But I'll never forget, 4 months in, my team, out of 3 teams, a part of this financial group, we were in the lead. And one of the other associate advisors, basically during a meeting, he stood up and he said, Trey, and he named the lead advisor, are having the most success. And Trey doesn't even know what we do here. And well, I think he was kind of making fun of the fact that I didn't understand the market well. What he didn't realize is that I understood people well. But the reason that I was successful is because I was a part of a team of people that had been in the business for over a decade, that knew what they were doing. They were great at what they were doing, and I was just functioning in a relationship role. So the reason I say that is since July of 2015, I've learned so much about the stock market, tax planning, Social Security investments, how they all play a role together. But one of the things I would say, and I'll hand it off to you because you and I are different in this arena, is that I am your traditional salesperson from the standpoint of I love that feeling of purchasing something that I've wanted for a long time. And one of the things I would say that I didn't really feel that same excitement until 2012 when I opened a 401k is when I started investing in my 401k in January of 2012 in my first career. At first, it just felt like I was throwing money away. Like here, I see this deduction on my paycheck and I see how little is going into my account. But in my 3rd year of contributing to my retirement account, I couldn't believe how much that bucket of money had grown. And it was the first time that I had the exact same excitement or feeling of seeing my money grow as I would buying a new car or purchasing a golf cart or whatever those things are. And so when we talk about investing, one of the things I would say to everybody is kind of a start is if the sooner that you can invest, even if it's $20 a month or a couple $100 a month, when you can see your money grow without your effort, that's one of the most rewarding feelings when it comes to investing. So Warren Buffett has a quote, someone is sitting in the shade today because someone planted a tree a long time ago. That tree is investing. So one of the reasons we love what we do is we help people set themselves up for retirement. And so before I hand it off to you, I guess one of the things I would say when it comes to investing is the earliest you can start, the better. If you start today, it's great. If you didn't start yesterday, start today. Because when you look 1, 3, 5, and 10 years down the road, compounding interest really is unbelievable. And when it comes to investing, I would say a lot of people, 40-some% of Americans don't own any stocks. And so if you're one of those, if you come from a family that didn't have a background of investing and putting money away like I came from, you know, my parents invested in real estate. They weren't big in the stock market. And so my knowledge of that was so little. But if you're from a family like mine, I would encourage you to be the first to get your money in the market. So for you, Yelisey, when it comes to investing, what was your start as far as in the stock market? Because you started in real estate as well. So what did that look like for you? And when is the first time you felt the magic of compounding interest?
I guess just to piggyback off of what you said, the biggest mistake that you can make isn't necessarily with the types of investments you choose, but the biggest mistake is not having the wherewithal to know that you should get started. Don't let the fear of not knowing everything keep you from actually making that mistake. So I would say getting started is really important. And obviously you can't really have a conversation about investments without mentioning Warren Buffett. Everybody often cites what he has to say. But the thing is that you notice that a lot of people, especially in our generation, like they want to be able to plant the tree and have the ability to benefit from the shade tomorrow. And I think that kind of like what you said, you don't experience the benefits of compounding interest until later. In the beginning, it's just like, it's about consistency, it's about being disciplined, and you're putting all the money away and you're not really seeing the results. It's not until really that the growth itself is earning interest too. And I think that that's when people get that aha moment, like, hey, I can actually do this. And it's not just me constantly plugging away and seeing the reductions in my paycheck, but I'm also seeing the growth on the growth, and then eventually starts to compound.
So when's the first time that happened for you?
Well, the first time it happened for me
in the stock market.
Gosh, and I started in real estate too. So I got the benefit of like, we bought and sold properties. We flipped a few properties. So that was a little bit more immediate. But with the stock market, I would say, I hate to admit, probably in my late 20s. And like you said, like there is no substitute for starting early. A lot of times people think, well, my career is going to take off later. I'll have a little bit more cushion and I'll be able to make up for the lost time. It takes a lot more dollars than it does. Like if you were to start early, we have an example later on where we talk about just simply investing $100 a month. If you do that in your early 20s, it takes a significant amount of money for somebody in their 30s to catch up to that.
So how many years into investing did you feel the compounding effective interest where you logged into your account and you were like, this isn't just the money I put there, this is actually working? Like, what was that first feeling? When was it?
I don't know when it was. I do remember the feeling.
Yeah.
And I think for me, it's, there's a simple rule. Maybe it's a little bit too simplistic, but there's something called the rule of 72. And you basically take 72 and you divide it by your projected rate of return. That's how many years it's going to take to double your money. So I always knew, like, hey, if you divide the rule of 72 by 10, I'm going to double my money in about 7 years. So I knew that would kind of happen. So I think for me, even in the early days, that probably kept me a little bit more, I would say, disciplined, because I knew eventually it would double.
Yeah.
But I do remember the feeling of like, hey, this is a good year. I made some, you have the money that you make from what you do for a living. And then you look at, hey, that plus the money income I made in the market.
Right.
Like, hey, that's actually a pretty good year.
Yeah. So exciting. So point number one is, why do people avoid investing? I would say the first thing which you hit on is the fear of investing.
Yeah.
Again, if you come from a family like mine, on one side, my dad's dad was a hair barber, was charging $11 a haircut for 50 plus years.
Right.
Finally got up to $13 a haircut. And I think the last couple of years, $15 a haircut. He was investing, but it wasn't a significant thing. It was kind of just enough. On my mom's side, my mom's dad, he never saved anything. In fact, he was so good at spending money, he spent other people's money and spent a lot of time in prison. So the reason I share that, though, is if you're listening, if you don't come from a family of wealth, we want you to make sure that a family of wealth comes from you. And one of the things I think is such a big deal is we do live in a generation that everybody wants microwave results, right? Everybody wants them quickly. But one of the things that we know is that if somebody is disciplined and they just create great habits, that's going to lead to a great life. And one of the things I think that I've even learned over time is that if you want stable wealth or stable success, you don't do it overnight, you do it over time. But if you are somebody that does well and you start by doing a match, so most employers, they match at 3 or 4%. So right away, right when you get started working, if you do a 3 or 4% contribution, and then you get to 7 as fast as you can, and then 10 as fast as you can, and then maybe 15, and then you diversify to other things, what we would encourage people is just get started, because in your lifetime, you could be the one that changes it for generations. And I think that's really exciting. So we'd say most people don't get started because of the fear of it. They don't get started because of lack of education around it. And a lot of them, again, have never experienced that wonderful feeling of seeing money work for you. Yeah. What would you say are some of the reasons why people avoid investing or even getting started?
Well, I guess I'll start by saying a mistake that I've made. There have been many times where the mistake I've made was sitting in cash for too long. Like, having the cash build up,
waiting for the right moment.
Yeah, waiting for the right moment, and the right moment never comes.
Right.
And it just, there's volatility in the market, and even when it dips, are we just getting started, and is it going to continue dipping more, or has it dipped and is it about to recover? Like, you're always playing these games in your mind, and what you find is it's better to just invest the money, because over time, and here's an interesting stat, they actually say that the worst days in any given year in the market, like if you look at the worst days, within 2 weeks, you're probably going to experience one of the best days in the market.
Right.
And JP Morgan actually did the study where they looked at the last 46 years in the market, and they said that on average, the intra-year loss on average is 14%. So that means in any given year, the market's going to dip on average 14%. But in the last 36 out of 46 years, the market has ended positively. So even if we experience those things, and I think the fear of missing out and like, hey, am I buying in at the height of the market? Is it just about to correct? Because I think when you and I probably first started thinking about investments, like we were in college, 2008 just recently happened. And it was one of those things where everyone saw their 401ks turn into their 201ks. So I think that fear that a lot of maybe our parents and the people who were older than us, I think some of that probably carried over to us too.
Yeah.
You know?
Well, I think fear is a real thing, right? So the other thing is Bankrate in 2024, they had an article that said 1 in 4 people have never started investing because they don't know enough. You know, one of the things I've noticed, and one of the reasons I love the financial world so much is because finances are so similar to life. So why do a lot of people not apply for the job that they want? Why do a lot of people not start the business? Because they don't know enough, and it's fear. And we have to decide in our lives, are we going to live by fear or are we going to live by faith? I actually like this one. Fear of loss is psychologically twice as powerful as the pleasure of gain, according to Nobel Prize winning Daniel Kahneman's on Project Theory. So here's what we know. For most people, pain is more significant than even gain. And I think one of the things that you have to decide is, if I know I'm going to have losses along the way, is it worth the reward, or is the pain too great? And that's why one of the most powerful things I think a person can do is they can pre-decide that I'm going to choose to get started even if there's pain, because the people that are winning are people that have tried and have failed. And so one of the things I would say, and it's probably been true for you too, but is that failure doesn't scare me, doesn't make me nervous. In fact, one of the things I've noticed is the people around me that are failing are typically the ones that in the next 1 to 3 years are going to be the people that are winning, because they're trying. Where most people are just pointing out who's winning and who's failing. And so when it comes to investing, what I would say to people is just get started. Like, find somebody that's great at this and say, if you were me, where would you start, and get started? And you're even going to be ahead, even if you choose the wrong investments, which we can help people not do. But even if you choose the wrong ones, that pain is going to help push you, if you choose right, to find the right ones instead of quit.
Yeah, we actually just had this happen in real time yesterday. Not that somebody made a decision, but we were reflecting on some of the decisions that one of our clients chose to make.
Right.
So in 2020, they basically said, "Hey, we're gonna stop the bleeding. We're gonna cut back." Now, they didn't pull all their investments out. They did something a lot more rational, which you would think, hey, this is actually a smart conservative decision. What they did was they switched from a 50-50 model to a 30-70 model. 30% in equities and 70% in bonds. Now, we all know what happened in 2020. Of course, we saw record gains almost a month after the dip that we had from COVID.
Yeah.
Of course, 2022, they looked like they made the right decision when 22 was the worst year since 2008. But then ever since then, the market's just been going really great, and they've missed out on all of those returns by making what most people would say, hey, you're in retirement, you probably could pull back, let's stop the bleeding. That actually sounds like good advice.
There's a leadership lesson in this, though.
Yeah.
For that couple, like a lot of the families that we serve, not only were they concerned about the stock market, one of them was going through a health challenge. And here what I've noticed in my life is that in my life, when everything's going well, it's easy to be optimistic in every area of our life instead of compartmentalize things, meaning that they weren't sure if one of them was going to make it. They thought that one of them, the person that was sick, literally might not make it another 6 or 8 months. So what did they do? Instead of continuing to invest in the way that had continued to work, they pulled back. Now, sometimes it makes sense to pull back, but what you don't want to do is overcorrect, where you go from living in faith or living, I would say, knowing that the market's going to continue to do well, to living in fear. So you can reduce your risk, and there are seasons of life to do that, but they overcorrected. And then we had 5 years from 2020 to 2025 where the market was gangbusters. Nobody knows how or why, but the market has done so well. And instead of averaging 15 to 18%, they're averaging 8 to 10%. So the reason I say that is because it's really important in life that you don't let one area of failure cause you to lead to make decisions that you lose in everything else.
Yeah. And, the interesting thing about this family, we often talk about the need to take risk, the willingness to take risk, and the ability to take risk. This wasn't a family, like they could have said yes to all of those. I mean, not yes to all of those, but they didn't need to take risk. Right. They had the ability to, but they didn't have the willingness to because of that fear factor. It's kind of like the prospect theory that you're talking about. Like if you were to pose this question to most people, would you be more comfortable with losing $1,000 or gaining $1,000? Kind of like you said, the emotional experience of losing money is so much more impactful than it is when you were to gain something. I think most people are kind of in that category. And even this family that they could have taken the risk. They're actually not even drawing on their assets. They're
never going to touch it. They're living on Social Security and pensions.
If anyone is a candidate for increasing their risk,
right,
it's these people. Right? It would take a significant financial emergency for them to have to dip into their savings. But even still, they made the wrong decision because of the emotional triggers that affect all of us.
Yeah, absolutely. Earlier, when we were talking about today's podcast, one of the things that you mentioned was inflation and how it impacts savers.
Yeah.
I want you to go into that. But one of the things I would tell people is in your life, one of the things that you have to decide is I'm going to be somebody that accumulates or somebody that multiplies. So what does that mean? We meet with people all the time. They might have 1 or 1.5 million, and they'll have half that money sitting in bonds or sitting in checking and savings or sitting in like a T-bill account, and we're all for safety. But one of the things that's worth considering, is it worth sitting there fighting inflation, or do we want to multiply these assets? So one of the things I did 2 days ago, I was sitting with a couple that's walking through our educational process on what can I improve. And I showed them, if we just take you, actually it was a separate couple, but from a 30-70 to a 50-50, get them up to where half their funds are in the stock market, in stocks and equities, that their average returns based on the last 5 years would go from averaging 4.5% to 8.5%. And I showed them that they would leave their 3 adult grown children twice the money in 25 years. And I showed them that because they were also living on just Social Security and pensions, their expenses are so low, and both him and her had pensions of $3,500 to $4,000 a month each.
Yeah.
They are considering giving her pension to their 3 kids because they don't need the income, like now, today.
Wow.
So the reason I say that is for that couple, I said, hey, I'm not trying to convince you guys to be aggressive or even moderate aggressive. I'm trying to get you to being moderate conservative, because for you, you have the need, your need is none, but you have the ability and maybe you have the willingness to see this money as legacy dollars, and we can get it there.
Yeah. Speaking on inflation, I'm sure everyone's sick of the topic, but there is a perspective that I think a lot of times isn't shared. One of the questions we often get from our clients is, what's the best hedge against inflation? And in the most simplistic terms, it's investment, right? If you, for instance, let's say you own a house, you own the real estate, maybe you have a mortgage on the real estate. Well, inflation oftentimes causes the value of the home to go up. I know there's other factors. And in real terms, it causes your debt, the mortgage on the property, to be diminished, right? Because that's not going up just because inflation is. But if we have more dollars circulating in the economy, now, of course, there's a real argument to be made whether or not wage growth has kept up with inflation. But for the most part, wages continue to trend upward. So having an asset, a real asset like that, could actually be a good hedge against inflation. The stock market, for instance, people who have a 401k have really experienced the benefits of inflation in their 401ks, right? We've seen that. Mm-hmm. But if you're somebody who hasn't invested, if you don't have hard assets like that, for you, probably the talking point is milk, cheese, and eggs, and the fact that you can't afford anything, and that your rent is going up in your apartment, and everything is more expensive, and your insurance cost is unaffordable. It's pricing you out of the housing market, and all the negative things that we attribute to inflation. Those are all real things. I just think they affect people differently. People who've chosen to invest in hard assets like real estate, like the stock market, are affected differently than folks who are living paycheck to paycheck, where wages aren't keeping up and they have the real cost that they have to deal with daily.
To summarize point 1, the real risk isn't investing, it's not investing.
Right.
Just like life, the real risk to life isn't taking the risk. The real risk is not taking the risk. Point number 2, the core concepts that you need to know. So John Bogle, founder of Vanguard, championed index funds. Don't look for the needle in the haystack, just buy the haystack. So the way that we manage money at All Things Financial is we use mutual funds and exchange traded funds. So what does that mean? Instead of buying a handful of stocks or equities like Tesla, Apple, Meta, whatever that would be, we believe that diversification and good index funds over time give you stability and good returns. What would you have to say to that?
Yeah, so there's a million studies that show if you miss even a handful of the best days in the market, like you can cut your returns in half. So most of the studies, they look at a 30-year term. So if you pick any 30-year term and you say, hey, over a 30-year period, imagine if you just missed the 10 best days. You can cut your return in half. The problem is nobody knows when those 10 best days happen. Right. I already mentioned earlier, like most of the time they happen like shortly after the worst days. So a lot of times if you're hitting the panic button, if you're selling just because you're trying to stop the bleeding because we've had a couple of best days, chances are you're going to miss some of those best days. So I 100% agree with that.
So goals on main two, the core concepts. Number one is index funds. Number two is don't just invest a chunk of money, invest dollar cost averaging. Make sure that like a car payment or like a house payment,
right,
that whether it's weekly or biweekly, that you're continuing to add funds to your brokerage account, your retirement account, etc. Anything under number two that you want to hit before we move on to number three? We spent a lot of time on point one.
Let's move on to point three.
How to actually get started. Hit it. Step one.
So, one of the biggest things that we talk about is the 401k, right? That's an easy
free
one.
money.
Free money. And we talked about, hey, investing is a long-term thing. You don't really see the fruits of it until later. Not with the 401k. If your employer is making that match that you discussed, well, you're getting a huge rate of return right off the bat.
Right.
If you put in 3% and they're matching 3%, you just doubled your money. So that's actually a great way, I feel like, to have a good positive experience, especially as you're starting out. And by the way, what we find is most companies now, they're automating 401k enrollment. And that's actually creating a huge benefit. I think on average, we're at a 13-year high for 401k balances in general, even though most people are taking more hardship withdrawals than they ever have due to inflation and also due to automatic enrollment. So I would say that's a no-brainer.
Okay, step 2 and 3, I'll hit both. Number 2 is open up a Roth account. So as long as you're making under $161,000, you can open up a Roth.
As a single person, yep.
Significant, you should do that. Yep. Number 3, how do you invest? Invest in low-cost, diversified ETFs. If you've got questions on that, you can reach out to us. That's something that we excel in, and we'd love to help you.
Yeah, I can just add a couple of things on that. So most of the time, like, we're not trying to say one investment is bad and one investment is good, but ETFs compared to mutual funds, there's a huge advantage. For instance, on a mutual fund, there's a fund manager who's placing trades. They're choosing, if it's an S&P 500 mutual fund, they're picking which of the 500 companies are the best ones to place in that mutual fund. Every time they place a trade, there may be a capital gain, and that gets passed on to the holder of the mutual fund. So imagine you didn't place a trade, you didn't sell the fund. In fact, maybe you don't even have a gain for the year, but you have a capital gain on your tax return. So you're paying taxes on the decisions that someone else is making. With an ETF...
And on money you're not using.
And money you're not using. On an ETF, that's not the case. Now, of course, we're talking about after-tax dollars, not mutual funds within your 401k. And there's a lot of other differences. The biggest one I would say is cost. Most mutual funds, on average, cost about 1 to 1.5% compared to 0.1 to 0.2% on an ETF.
Automate your contributions. Get it started. Set it up, just like your house payment, car payment. Don't have to redecide if you're going to keep investing in your future. Set it up once.
That's right.
Don't make the decision every month. Make the decision and then manage the decision. And then conclusion, never lose money. Warren Buffett's number one rule. Now, I don't know how that's possible, right? Because you're going to lose money. But if you stay consistent and you stay in an index fund, over time, it's proven that you're going to continue to do well.
Right.
Other things?
I think that's a great way to end the episode.
The best time was to start yesterday. The next best time is today. Thank you for joining us on All Things Financial. If you'd like a second opinion on your overall investing, you can reach out to us at atfwealth.com or give us a call, and we'd be happy to meet with you. Thank you and have a great day.
Advisory services are offered through CG Advisory Services, LLC, a registered investment advisor, and through Guardian Wealth Strategies, LLC, a registered investment advisor. CG Advisory Services, LLC, and Guardian Wealth Strategies, LLC are separate and unaffiliated entities. The topics discussed on this podcast are for educational purposes only and are not intended to be investment advice or recommendations. Listeners should consult with their own financial professionals before making any investment decisions.